is that, a order block? Farther to your left?
Let me, what the hell? Okay, yes, yeah. So essentially what ended up happening here, and I'll actually open the chart for you guys on there, is essentially what I ended up seeing was I ended up seeing a form of distribution called redistribution, right? And that form of distribution essentially looks a lot like accumulation, but is meant to throw you off because it never actually performs a bullish structure, right? So right here we have the supposed spring, right? Who knows their Wyckoff formation right now? Like, who knows their Wyckoff formations? And if you don't know your Wyckoff formations, that's fine.
I'm like halfway. I'm like 50-50 with it.
50-50. And who's speaking, by the way?
This is Chewy.
Chewy? Okay. So you're halfway. I've been working with you a little bit longer, so I'd expect you to know a little bit more, but that's fine, right? We can go over them. So essentially, a Wyckoff schematic is essentially characterized by a couple different formations. First off, accumulation usually happens at the end of a downward impulse, right? Impulse or expansion, as I taught you guys yesterday, right? Impulse is another word for expansion. So usually it's characterized by this position right here called the selling climax, right? So the selling climax right here is also abbreviated as SC, right? You'll see that as abbreviated that like that in different schematics or different places that you may see.
Ain't the next one an automatic rally?
Automatic rally, perfect. Now the automatic rally happens why? So like knowing these phases is fine, but you have to understand the why behind it. So why do you think these automatic rally happens?
Some with the banks.
Some with the banks, okay.
This is to shake off the sellers, scare off the sellers.
Shake off sellers, yeah. Late sellers. Right. You see how volume spikes here? Even though movement doesn't really happen in this position right there? Like movement, like this candle didn't move very much, but volume spiked, right?
Mm-hmm.
That's essentially telling you, hey, that's not where the market wants to go. The movement before, the market doesn't really want to go in that direction, meaning that it did not want to go up in that moment, right? So what are you going to expect? At this position, you can draw a zone, right? You can draw a zone and you can say, okay, this is the top of my trading range. Usually, you will end up in a range, right? Now, your selling climax is going to be the bottom part of your accumulation range. However, there's a couple things that discredit accumulation or make it become redistribution, okay? Now, the first one that that is very obvious, first off, so okay, let me backtrack a second. Selling climax into automatic rally, right? Automatic rally goes into what? Does anybody know this?
No idea.
No? So the automatic rally leads into the secondary test, or ST, in phase B, right?
So the secondary test starts phase B?
Yes, the secondary test usually starts phase B. Okay. Now, what ends up happening is a lot of times you will get a range hitting back here, right? You will get the range to hit back here. However, sometimes it misses, it's fine. Not every schematic is going to look like this one. And I'll show you guys exactly where I learned my Wyckoff schematics from. It's from this right here. And I'll send the link out to you guys in the chat. Well, actually, this is going to be to Hav and to Andrew, but I'll send it to you guys also later, so that's fine. Okay, so this is essentially where I learned it from, right? But at the same time, every schematic isn't going to look exactly like this. There's going to be certain variations in the market. There's going to be certain variations to those schematics. Sometimes they will look rounded. Sometimes they won't look like a straight line. It'll look a little bit rounded. But what you want to focus on in this schematic is whether or not the spring is actually respected by the test. As you can see, right, this can really be the thing that you focus most on. This is really just identifying the schematic And this becomes whether or not the schematic is valid, okay? So for example, the spring going into the test has to be respected by bullish order flow, right? Does everybody understand what I mean by bullish order flow?
Basically buying up, right?
Basically buying up, right? Essentially, there is no bullish order flow if the test falls below the spring, because then it's just a bearish flow, right? It's just flowing bearish, correct?
Mm-hmm.
So if the test is not respected by the last point of supply, or the other test, what ends up happening?
It's a fake accumulation, right?
It's fake accumulation, right? And that fake accumulation has been painted by the banks before. I've seen it happen many times. So we have the spring right here. Now, usually when I taught the guys at Empire, when I taught them and they were first learning, I would tell them to say possible spring, not spring, possible spring. Because up until this point, say we use like the replay tool and we're right here and it comes back up. This is a possible spring because this zone, this trading range right here, right between these two zones is called the trading range, has not been respected completely yet, right? Since it hasn't been respected completely, meaning it hasn't come back and tested, it usually is not a good position. Now, another reason why I would not consider this accumulation, or I would consider this fake accumulation, is because of this. In this position, where do you see a sign of strength? Where do you see a sign of strength, if you even see one?
You don't for
You don't see one.
I just see a wick right there, but that ain't really nothing.
You don't see any signs of strength. It doesn't even reach the top of the trading range, which means that this here, right, and this here respected each other. Since this respected each other and it never broke this one, right? So I'm going to focus very, very heavily on fibs because that's what helped a lot of new people come in, right? And later you'll be able to do it without your fibs, but for now you can use these as a little bit of help. So right here, your one was never tapped, your 88.6 got tapped, right? And your 88.6 and between your 88.6 and your 79 is what you want as your kill zone. Why do you want it as your kill zone? Can anybody tell me?
For some reason, bro, my fibs don't look like that.
Probably because
Like
you
the
don't have
levels.
yeah, they're different levels. They're different levels, bro. I'll pop them up for you. Take a screenshot.
Alright.
Those are my levels.
We're at.
That makes sense?
That's it. Yeah.
Okay. So now your 88, can anybody tell me why the 88.6 and the actual 79 is why I want to aim for that position there?
I don't know like the book reason, but from like what I've been seeing, at the top of the range, it's always a little bit short, and I guess like that's like the strongest point it will touch before it shoots off. I know that's not really real descriptive, but like I understand it more than I can explain it.
Okay, let me get back to you on that in 1 second. Cool. So essentially, do you guys remember the theory of extremes that I posted up yesterday?
Yeah, isn't it the like that area, the extreme kill zone?
Yeah. So usually, so let me type this out for you guys so you guys can have this in your notes, okay? I think that should be fine. The market algorithm, right? Because it's universally known that the market is moved by the algorithm and it is abused by the banks, right? So the market algorithm prefers extremes because of the fact that liquidity amasses at extremes and retail slash what would you call them? Yeah, you could say that retail orders. Does that make sense to everybody? So the extremes theory essentially is the market algorithm prefers extremes because of the fact that liquidity amasses at extremes and retail orders are shaken off at the extremes, avoiding payouts for retail. Remember what I told you guys about brokers? That brokers are owned by smaller banks, which are owned by bigger banks? The less banks have to pay out to people, the more money they'll get to keep for themselves, right? And believe it or not, there is a lot of people trading Forex, right? There's a lot of money being traded, right? The banks, they'll take 150,000, they'll take 200,000, they'll take 300,000, which a lot of people are actually trading. And a lot of people actually lose because they don't know what they're doing, right? So essentially, let's say retail has a position that looks similar to this, right? Let's say we just have a, what color do we want? Let's go blue. So let's say an Asia session, right? An Asia session, price ends up doing this. What can you infer about Asia session? Like, what have you been taught about Asia session? If you've been taught anything.
Usually like
Nothing. So do you guys know what Asia session actually even is?
No.
Yeah, I know. Yeah, I gotta look in my notes, but the time and I forgot the time frame.
Okay.
But I can look in my notes and find out.
Essentially, for me personally, Asia session starts at 5 broker hour and ends at 12 midnight Eastern. Okay, or at 1 p.m. Sorry, 1 in the morning Eastern. Right. The reason for that is simply because Let's see who he gets for QB. Hey, wait, who just got Merge? Let me see something. Not bad. Wait. Merge, you're starting QB. Okay. So Asia session usually starts at 5 p.m., right? And then ends 2 hours before London, okay? So from broker hour to 2 hours before London. And the reason why I say that it expands from that position to the other position is because during the market extreme, like during that market position, price will usually consolidate on most pairs, okay? It'll usually consolidate on most pairs and it'll essentially do something like this, right? It'll range. So the two pieces that you want to mark are Asia high and Asia low. There's a reason for that. Because that's daily structure. Okay? That's daily structure. So for a lot of people, a lot of big equity investors, a lot of people who give their accounts to people wherever they may be found that just meant say, oh yes, I can give you good return, and we split 50-50. Like that's essentially where all this money comes from. They're gonna have buy stops here because they're gonna try to play like quote unquote pro traders, and they're gonna go for breakouts. The banks know this. So what are they gonna do? They're gonna take price and they're going to move it to extremes. Okay? Meaning they're gonna break Asia session low, trigger these sell stops, come back, hit their stop losses, then they're going to come back up, trigger buy stops, and then come back down, hit their stop losses, and keep going into the actual move. Okay? Now let's go see if this actually happens. Let's see if I'm not just talking shit. Let's ignore this for a little bit. There's another example. Let's what other pair? What pair? Actually, that's how I got to you. What am I talking about? That's how I got to you because I saw the Asia session, Asia range. So let's look at the Asia range. Where is the Asia range? Hello? Oh, wait, you're not in Asia. Oops. Let me get rid of this. Let me go up to the 1 hour. Here we go. So essentially, yesterday's Asia range was right here, right? Yesterday's Asia range was right here. And I knew one of two things was going to happen right here, right? I knew one of two things was going to happen. It was either going to hit this position right here, right, and sell off to break it first, or it was going to go up and break this first and then continue going down, right? Again, the break of Asia range. Asia range starts like this. And whoever wants to know the indicator I will show in one moment. This is a very simple indicator. It's just for time frames. It is this one right here. It is the Patty trading sessions. And I should probably change this to 00. Like that. And I have London session off. So screenshot this if you need this. Okay. And essentially what I end up doing is I end up saying, okay, let me look at structure in this position once 12 hits. Okay. 12 hits and I start seeing this position start coming back up. So I, looking on the lower time frame, I'm saying, okay, this position right here is going to go one of two ways. It's either going to dump off, breaking Asia low and continue on for London and reverse to New York, or it's going to keep going up, reversing for London, and then once it hits this OC, it's going to actually come down. Now, what is an OC? An OC is an outcome candle, right? Outcome candle or institutionally sponsored candle. Reason for them is because a lot of times price moves so quickly because banks know exactly where they're going and they're so precise that they hit the point that they want and then drop off. The quicker, the better, because of the fact that retail traders don't have an actual chance to get into the move with them, or their stop losses will get hit before they can actually move them, correct? So from here, where would you go if you're looking at this on the 1 hour and you can't tell where price is going to head toward, if it was going to break Asia high or Asia low first? Where would you go?
Check the higher time frame.
Higher time frame?
Yeah.
Why higher?
I guess I was wrong.
No. I want to know your thought process. Why higher time frame?
Well, you said you want to know where it goes just to kind of see where price has been.
Okay, so see where price has been. You see that over here, we really don't have much points of interest. We have a block that was already mitigated. We have another order block that was already mitigated. Sorry, a breaker that was already mitigated. So there's really nothing there. There's nothing here. There's just kind of a void. So you want to focus on current price action, right? You want to focus on the current price action. So I'd go to the lower time frame to see where it's going at this point and whether or not it's doing something worthy of noting. So at this position, this is where I sent out my first actual hypothesis on the trade. And I said, well, this looks like something of a sloppy accumulation. So maybe we can see, you know, a push up. But then I sat back down and I reanalyzed it and realized that this is actually something known as redistribution. Now, I spoke about this yesterday, but I didn't actually touch on it. And there's a big reason for it. Because of the fact that people were going to get confused. Redistribution essentially happens when accumulation should, but does not hold bullish position or order flow, right? It doesn't hold bullish order flow. So right here, because it's coming from a downward impulse, you would immediately assume accumulation, right? That's what a lot of people would assume. But if the actual accumulation schematic does not hold bullish order flow, there's no reason to take it. There's like it'd be kind of silly to take it. There'd be no reason to take it. Let me see if I sent this out to the right person. Okay, yeah, I did. So there is no bullish order flow here because these lows were held. Do you guys remember what I taught you guys yesterday on the position of the upthrust after distribution? You guys remember this? this right here, the upthrust is never even mitigated. So the upthrust is mitigated, but there is no spring. Without a spring, there's no accumulation, is there? There's an upthrust here, not a spring. Which means that if we would fib this on the lower time frame, what do we get? We get a perfect optimal trade entry, right? Now, would we have known that that was going to happen? No. We would have expected, you know, that to be a spring and then it continue up, right? Now, did we know that at the time? No. So we wouldn't have taken this trade. So this trade is kind of invalid, but the fib is still valid, right? Because there's no way you would have caught that. There's no way you would have caught this unless you were psychic, right? But now you have an extra form of confirmation in the sense that you now see that there is no bullish order flow here because of this position right up here. There is no bullish order flow. An order flow is really just a simple term for it going up. It's a fancy term for like there is no bullish indication here, right? So if you are moving from this position to down here, and this was mitigated like an order block, which I will explain in a little bit, there's no reason to take this sell. Sorry, this buy. There's no reason to take this buy. So as soon as I saw this, I said, nope, this is redistribution. And that's when I sent out my updated version of the trade, which essentially said, hey, most likely we're going to see another push up and then a pretty big push down, in my opinion. Let's see what happens. So we end up getting pushed up again, right? We end up purging these highs. Like I said, the market likes to control extremes, right? This right here was mitigated, and then this right here captured this liquidity on this position right up there. But again, even if you waited for it to play out, it never actually created a bullish order flow. Now this right here, you could have said, oh, well, maybe this is bullish order flow, but it never showed that sign of strength. That sign of strength never actually came. It wasn't like a massive push up and then you would have gotten in on a retrace.
So, what is your example of like massive strength move?
Massive strength move. Let me show you on GJ, and I put this example up on a previous class, but I'll show it again. It was GJ on the weekly. There's GJ on the weekly. Back here, and let's get rid of this eyesore. Okay, so you see this? This here is distribution. This is clean, unaltered distribution. From here to here is distribution. Now this here is a sign of weakness. And if you weren't doing it in accumulation, literally just flip your eyeballs, that's a sign of strength. And you would have gotten in on the retrace. Why is this a sign of strength? Because it broke the trading range. It breaks the range, and now you await the retest, and then you enter. So at this point, to make it easier for our new people, fib it, right? Our 88.679, you would have gotten your entry right around here, and then you would have put your stop loss at the 1, right? What ends up happening? It comes back down and fills this wick. Something that a lot of people don't know is that wicks get filled. Giant wicks that you see spike up get filled. Does it have to happen immediately? No, but it will happen. Like you see right here, it actually came back up. Why? Market extremes. Markets like to target extremes. After it makes a move, which already targeted this extreme, you have this sign of weakness. Now you know that this sign of weakness is going to get mitigated in the future, but a way to retest. So what do? You look at previous structure. Where is the previous extreme? Right here. So what are you going to do? You're going to wait for price, and you're going to be bullish on this pair for a couple weeks until it actually hits your OC right here, right? Oh, sorry, your POI, point of interest, POI. I'm going to abbreviate that, okay? And once it creates this sign of weakness, you should be expecting bullish orders from, for a while until it actually hits your weekly fib. And then from there, what you can do is you can take this entry and you can say, okay, cool. Now what I'm going to do is I'm going to watch its reaction here. And what happens? It comes up, it comes down, and then it goes all the way down, right? Comes back, gives you another entry, and again, all the way down. So right here, what can we expect right here? What can we expect this? We can expect this liquidity, right? This is known as sell-side liquidity when stuff like this happens, right? These giant candles. Sorry, these giant wicks, not candles, wicks. These are known, this is known as sell-side liquidity, okay? And that sell-side liquidity is essentially going to get captured in the near future, right? It already targeted its previous extreme, so what should we await for? There's only two options here. It could go back to a previous extreme, meaning up here, or it will just continuously drop off. And that's the magic of you looking at current price action, right? Because if you're looking at current price action, you're going to allow yourself to look at the relevant price action, not at the price action that happened years ago, right? So you're going to look at the stuff that's relevant, because this right here is relevant still, right? This right here is still relevant. This is what I want to target. I just need to find my entry, right? Now, as you know, price doesn't move in a straight line. It gets from point A to point B, but from point A to point B, it can go in a zigzag, right? So let's say this is a previous extreme or this is a previous extreme. Either way, if you were to have that, you did hit your OTE, right? If you wanted to reduce it a little bit, you hit it again. Doesn't matter where you flip it from, it actually did hit its OTE. So for it to continue bearish order flow, where would it have to go? For it to continue bearish order flow, where would it have to go?
Is it a zero? To the bottom of that wick?
Right, so it would have to continue on downward to actually complete bearish order flow and capture this liquidity down here. Does that make sense?
Yeah. See,
Does
my
everybody...
thing where I get confused at is telling the difference between uncaptured liquidity or fair value gaps and what's already been captured. That's what I messed up at a lot.
Okay, no problem. So this is something that I call the left-right rule, right? And a lot of you guys may not have heard of this, but it's something that I have discovered over the years. It is called the left-right rule. And essentially, whoops. The left-right rule essentially shows this, right? Whenever you see liquidity on the left, right, that is available must be captured. Liquidity on the right that is exposed will be captured in the future, okay? So there are two targets of liquidity. First off, there's liquidity that's available. And actually, why am I typing it here? There's a bad idea. So let me explain it to you guys. So there's liquidity that's available, and there's liquidity that has already been captured, right? So anything like a breaker, anything like an inefficiency, that liquidity must be captured, right? It must be captured, but usually it's on your left, right? The right is where you mitigate that liquidity. So who can tell me what this is?
Fair value gap.
Fair value gap. I heard fair value gap. I heard distribution. This right here. I'm focusing on this right here, not this. This right here. So let me go ahead and actually take that off, and let me.
That expansion.
Expansion, right? So you a lot of you guys may not have actually heard of this, but I'm pretty sure Chris has. Chris, have you heard what this is? And if not, that's fine. Mitigation of this, right? Mitigation of that, mitigation of this as well. So essentially what it is, so let me explain to you guys something. The market really is only it's a game of liquidity capturing itself. It's a game of liquidity capturing itself. What do I mean by liquidity capturing itself? Essentially, right here, we have liquidity that was exposed at one point, right? What did the market come back to do?
Capture itself.
Captured itself, 50% of this inefficiency. Now, this is the term that I need you guys to learn, inefficiency. Usually, the market will come up with inefficiencies. Why? Because the market moves too fast sometimes, and that's completely fine. But when the market moves too fast and there's liquidity left exposed, example right here, this is exposed liquidity because there's literally nothing stopping it. Nothing stopped it. It just hit it and then it came back up, right? This inefficiency will usually get filled. Sometimes, right, if they're in bearish order flow, they'll get completely covered, right? Meaning if they're in the actual direction that price wants to go to, price will overtake it, right? It will cover it and overtake it. However, if it's facing the opposite direction, price will climb, fill it, and cover it at least 50%. Okay, at least 50%. And if we take out our fib and we show the inefficiency from here to here, right, the 50% is right here, and we actually wick it. Okay. So this position right here, you would have immediately said, hey, if you were looking at just inefficiency, you would have said, hey, I see an inefficiency candle right here, right? On lower time frames, you would have seen it as well. So this would have also been a daily order block. Who knows what an order block is?
No, I do.
I know what an order block is.
I actually need to study a little bit more on order blocks, but I know it's not a quick explanation.
So an order block essentially is a candle. It's a resultant candle, right? So there's a theory that I'm going to present to you guys on the team a little bit later, and it's called the hierarchy of price, which I will put into a PDF and I'll probably publish it either tonight or tomorrow night, okay? Essentially, what you're looking for in an order block is you're looking for the last candle that actually held any value. So let's make another page. So essentially, let's say that, let's go ahead and say, do you guys want a bullish or a bearish order block? Doesn't really matter.
Shit, whatever.
Both of them.
Bearish.
Both of them. All right, let's start with the bearish order block. So let's pretend that these green candles are bullish, right? So we have these bullish candles that are going up. But then we also have this one last bullish candle. Now, this last bullish candle is followed immediately by another candle that does this. Actually, let me not draw it like a lopsided melon. Here we go, right? This right here is its result candle, right? The cause and the effect candle. Cause, effect candle, okay? So now what happens? It starts dropping and dropping and dropping and dropping into oblivion, right? It just continues dropping. Now, me being a trader, what would you do with this information if this was a previous extreme?
Store the order block.
Create the order block
Yeah.
from the candle low.
Right. So how you trade an order block for all my new people, essentially there are 3 places that you want to keep your eye on. And it's the candle open, it's the 50%, and the end of the wick. And I'll explain to you why. Say you're in a downtrend, right? Say you're already in a downtrend. You only want to be looking for bearish order blocks. However, if you're in an uptrend, you really only want to be looking for bullish order blocks. You do not want to be trying to catch every single retrace in the market. You should be trying to catch where the market is generally moving toward. You don't want to move against order flow. You want to move with it, right? So since we're in a bearish position here, we know that price is going to return to this position soon enough, right? Now, let's say we dash it right here, right? Let's say we dash it. Sometime later in price, keep this order block in mind, because what price is going to do is it's going to come back to that position. Why? Theory of extremes, right? The extremes are always going to be targeted, right? Now, let's take a look at what's going to end up happening. The 50% is something known as your OTE, or your optimal trade entry. Okay, actually that's the 79%, but that's a different story. The 79%, which is going to be a little bit back here, is going to be your optimal trade entry, okay? Now the 50% is usually where I set most of my limits, maybe a little bit in front of it to account for spread, right?
Hey, bro, when you do stuff like this, don't you set the stop loss like close,
Yeah,
like right outside the top of the candle?
yeah. So you set, let me get to that in 1 second, okay? So essentially what I do is I place my first entry, right, at the open of the candle, because usually you don't want to miss it and you just catch it, right? You just boop, you get your limit tapped, and even if you're holding through drawdown, you know that the trade is going your way. But when you're dealing with like a 1.0 lot size on like a $200 account, you want as little drawdown as possible, correct? So what are you going to do? You're essentially going to take your OTE, your 50%, and the open of your candle, and you're going to say, okay, let me go to lower time frames and see how it reacts. Usually what ends up happening is the market will wick this position and then fall, and it'll end up looking something like this. Into more bearish candles. Okay, it'll wick that position, your limit will get hit, and you'll end up in profit. By the time other people are looking for their confirmations, you're already 70 pips in profit with order blocks, okay? So you want to set your limit either at the open or at the 50%, depending on your lot size, depending on your trading plan, whatever the case may be, right? Next, you want to put your stop loss. Some people put it at the close of the bullish candle. I don't. I put it at the top of the wick. Whoops, that is not what I want to do. Right here, which usually ends up being right there. So my stop loss will be right there. Right, my entry is going to be at the 50%. My stop loss down here, and then my take profit is at the previous low that this made, which could have been all the way down there. Down there is my take profit. Okay, down there is my take profit. Now, order blocks aren't just found on the 4-hour. They aren't just found on the 1 hour. They aren't just found on the daily. They aren't just found on the weekly. They are found in as little as the 1 minute, the 30-second, whatever you want to call it. Why? Because of the market extremes theory, right? Market extremes is supported by order blocks, right? It was actually derived from order blocks. So does everybody understand how to use an order block now?
Yeah.
Can everybody explain to me how to essentially make an order block or like spot an order block?
I use a lot of different stuff like rally based rally. I went through your Discord, so
Yeah. So so the rally-based rally, everything like that, that is fine. Rally-based rally, all of that is fine. But those are continuation patterns. Those are points of interest. Okay. Those are positions that you want to keep in mind, not necessarily trade off of. Okay. And I'll explain to you why. Okay. So essentially, those right there, right, the rally-based rally, drop-based drop, those are continuation patterns, meaning that you know price is going to continue in that direction. It's a confirmation that price is going to continue on in that direction. You just need to wait for the perfect time to actually jump into that position and say, okay, I think this is a good entry. Let me go ahead and jump in, right? A rally-based rally shouldn't just be your confirmation. And I'll explain what those things are later, because Hav is a little bit ahead of the curve with you guys. So how can you use this on stuff like HFX? What did I just say? That this is found where?
I don't recall where you said it was found, but this does look like optimal for finding the perfect entries on binary options to make sure that you just stay in profit throughout the whole contract.
So, perfect answer. Let's say, for some weird reason, right, we take a contract on the 5-minute or on the 3-minute. You need to keep in mind structure above those minutes, above those time frames, because price is fractal. Who can tell me what price is fractal means?
The same thing happens in every time frame.
Perfect. The same thing happens in every time frame. I'm pretty sure that was Terry, right?
Yeah.
Yeah. Perfect. The same thing happens in every single time frame. What is reflected on the 1 minute, the 3-minute, the 5-minute is reflected on the 1 hour, 4 hour, 12 hour, 1 week. Okay? Because it all builds into each other. So if there wasn't any 1 minute, there wouldn't be a 5-minute either, right? So let's say, based off this position, based off the order flow that's going on right here, where are we going to basically expect price to go to?
Previous highs.
Previous highs, right? Perfect. Previous high. Now this previous high is going to get taken out. So where would we actually expect price to go to? And we actually sent a limit on this out earlier. Where do you guys think price is going to go to here? Most likely. It isn't definitive because we aren't in anywhere close to it.
Possibly the 50% of that order block.
Of this order block right here.
Yeah.
Right, this order block right here. If there's liquidity that hasn't been captured up here, it could go for a liquidity sweep, but that's a bit more of a advanced concept. Let's say we go on the 2 hour. Could go right here. It could also, get the 50% of the inefficiency right there, right? So let's say we have two points that we are focused on, which is the 50% of this order block, and there is also the 50% of this inefficiency. Now, those two positions are going to be the ones that we are looking at, right? Now, if price comes up to that position and we drop to the 3-minute, to the 1 minute, and it never gives us a bearish entry, are we going to get in?
You don't.
You don't get in. There's no reason for you to get in, right? If the market doesn't tell you, hey, come on, let's go, it's time to fall, then you don't jump, do you? Obviously not.
No.
Now, let's say we go to our 20-minute, because I love the 20-minute. What do we see? Right here, it isn't a very clean one, but it is an order block, right? So we can say, okay, maybe price will come up a little bit higher, maybe right around there, right? And around this position is where I am most likely going to place my limit. Now, at this position is where I want price to come back to. This position is where I want price to come back to. I want price to at least hit this position and then either give me an entry for a fall or or come up, clear this liquidity, come test this high, and then fall, right? To take out buy stops, right? Either one is valid. Either one is valid. What you have to do is you have to take into consideration structure on the higher time frames, and then following those time frames, you will most likely get a very, very good entry off of your HFX contract, right? So say you would have taken your HFX contract on, what was it, AJ? Like 2 days ago. Say you would have taken your HFX contract, you would have popped up your trading view, and you would have traded a little bit differently than a lot of other HFX traders. And you would have said, hey, let me start with my top-down analysis and then take the trade on HFX as soon as I see a good entry that I would normally take on my actual Forex account. Oh, actually, here's another example of good liquidity clearance. You see how there's exposed liquidity right here? Exposed liquidity, the left-right rule, right? If on the left there is exposed liquidity, the right will very, very soon cover it. If it is within your trend, meaning that your trend is going down, and then the liquidity is exposed in the downward position, meaning that it's exposed down here, liquidity will take it and overtake it. Okay. However, if you are going down and liquidity shoots up, it will go up, fill it, and then fall. Just as an example.
That makes a lot of sense.
That makes sense? That's why in many inefficiencies that you see, like giant wicks, you see them get filled 50% and then just completely dump off the face of the earth. Right? I will explain to you how to catch those a little bit later.
I see.
However, right here, let's say you would have taken this and you would have said, all right, well, let's go ahead and check what's going on, right? And you would have said, wait, where was this? And you would have said, hey, let's go to the 1 day. Let's see what's happening here. Say you would have caught it right around there or right around here, right? And you would have said, hey, let me look at my 2 hour. Let me look at my 4 hour. You would have seen that right here is a bullish breaker. A bullish breaker essentially is when the market does something like this. Let me draw it out for you. And this range right here becomes the breaker. That makes sense?
Yeah.
Can you highlight the specific section of the chart that's that breaker? Because I see a couple different. Okay, thank you.
The most relevant ones are going to be the ones that are most recent. This is not a breaker. This is not a breaker. This has already been mitigated, so we don't need it, right? This is the most recent breaker, right? Now this breaker, and actually Mustafa called this an empire, and he did an amazing job of catching it. What do we see in this position? Not only can we go ahead and say let's do it in a simple analysis, in a simple take. What happens? It hits our 79, we buy, right? It's a kind of brainless thing to do, considering so you have your kill zone here. You have your kill zone here, so you should be looking at points of interest within your kill zone, right? You should be looking at points of interest within your kill zone, which in this case, it was the breaker. So it wouldn't have been your 79 that would have been your entry. It would have been your breaker that would have been your entry. So right around there. Now your stop loss, a little bit behind the 1, right? Since this is a fairly large stop loss, we say, okay, how can we minimize this stop loss? Very easily. Put it at the end of the breaker. And at that point, you have a regularly leveraged 30 pip stop loss. That's how you normally trade, right? Now, you can also look a little bit deeper into this, and you can even say, hey, what is that? You could say, that looks like a little order block. What ends up happening? Misses. Actually, never mind. Bad example. So a lot of times when you see a piece of structure and you zoom into it, a lot of times you may see little structure. Like you may see miniature structure within that structure, and you can use that to refine your entries even more, right? So in this case, you can put your take profit at the 0, right, which will end up being 237 pips. Wow. And you will have you would have risked 30 pips for 237, which at the end of the day is a 7 risk to reward ratio. Not horrible, not bad, not amazing, but at the same time, you also got an amazing reaction off of it. Look at that. You got an amazing reaction, fills it, comes back down, tries to come back down, fills 50% of the inefficiency, and then comes up. Right?
Hey, bro,
because
look. No, my God. My bad.
So remember what I just told you guys about the left-right rule? How if liquidity on the opposite side is taken, where's price going to return to, then go and then continue going in the correct direction? The what percent?
2%,
50%.
50%.
Right. So the 50% goes from here to here. Price misses the 50% a little bit, but still your liquidity was taken. If you would have zoomed this up just a little bit more, if you would have accounted for spread, you would have gotten that hit. Now let's say, since this liquidity was taken here and now it shoots up, that is another confirmation saying, hey, price is gonna continue bullish. So how did Mustafa catch this trade? He essentially caught this trade by looking at order flow on the 4-hour. And he said, well, there's no reason for this trade to go down at all. There's no reason for it to go down. So what's the most logical way for you to go about this? You go on the 2-hour, you go on the 1-hour, and you say, okay, what structure is around my 79, 88.6? Well, there's pretty good structure of a breaker here, this breaker right here. So what am I going to do? Well, I'm going to take that breaker into consideration, and I'm going to look and see what happens as soon as the breaker gets hit. What happens? Breaker gets hit. Where's my stop loss? Beneath the breaker, right? So what ends up happening? Since your stop loss is beneath the breaker, if it goes anywhere below, you know that bullish order flow has kind of been killed out, right? It's been snuffed out. So you want to focus at this point and looking for bullish options off of this breaker, right? What ends up happening? Rejects really well. Now what ends up happening? It just targeted its previous extreme. So what are you going to look for?
Sells.
Sells. You could look for sells, right? But also, what dominates the other time frames?
The 4-hour, I'm pretty sure.
The 4-hour, the larger time frames, right? And since this was never actually cleared, I would honestly expect consolidation to take out this liquidity, possibly hit this liquidity up here, and then that's where it's going to decide whether or not it actually goes, whether or not it actually focuses on continuing on upward, or it actually gives you a deeper retrace. Either way, you are around, what is this? Let me measure it.
Speaking of that, yeah, I might have to do that consolidation.
You're
if it does go into it.
115. You're 115 pips in profit from an entry that was given to you off of the 1-hour. Now, say you're trading HFX and you say, I want to have a good contract on this. Well, let me show you how you can do so. Let's go to the 1 minute. What's this look like?
Accumulation.
If you would have gone to the 30-second, you probably would have seen it a lot clearer. Selling climax, automatic rally, spring, coming back in for the test. Test is respected. So at this point, you start looking, hey, my test was respected. Sign of strength because it breaks out of the range. Now you await this. Now you await the breakout, right? You await this this position to come back up. And what actually ends up happening? It comes up, it comes back down, gives you an entry, and from there you could have taken that entry and rode that all the way up. If you weren't comfortable with that, you could have also looked at this previous low, right? And you could have said, hey, I'm going to catch an entry on those positions right there. But after this test was respected, I would have looked for the retrace, and that's where I would have bought my option. I would have bought my call, right? Because there is no bearish anything below it, right? Bullish order flow was respected by the spring in the test. The spring in the test, now the test was respected by the last point of supply. Since it was respected by the last point of supply, then that's when I would be looking for an entry on the retrace. Right now, I don't know if this is how HFX works, that you can close an option before expiry date, like expiry time, like in stocks. Can you do that?
You can, but it's not. You get money, but it's very detrimental to your account if you keep on doing it over and over and over again.
Detrimental how? Like you'll lose a lot?
Yeah, you won't get your full profit or your initial investment in full if you close too frequently. So it's really, at least for pocket options, this is one reason why I'm looking at race options and the other alternatives is that if we were to close prematurely, then we wouldn't get all of our money back. So you accidentally made a trade and you catch it within the first 10 seconds, then perfect, you're good. But if you're in a trade and you make a decision halfway through to pull it, you might as well have taken a loss.
Oh, makes sense. Okay, yeah, that's sort of what I figured because the same thing happens in stocks. Same thing happens in stocks. You get I think you get charged a penalty, but you see how lower time frames actually influence the higher time frames, and how looking at structure on the higher time frames will actually help you catch an entry on the lower time frames. So let's go and let's look at the GU position that I was looking at earlier. Okay, I saw this redistribution. I saw bullish order flow. Came back up, mitigated this order flow. Perfect. Let's say I would have taken an option from like for a couple hours. So I would. Can you do a couple hours? EQ? What is EQ? EA?
Maybe the EG.
Oh, EG? Okay, let me look at EG in here in 1 second. So let's say your redistribution gets filled, your liquidity gets filled. Now let's go down to the 1 minute and let's see what's up. What does this look like?
Extremes.
Like what?
Possible extremes.
Extremes, right? Perfect. So extreme comes up to extreme, never crosses its 1, comes back down, retest. This is where I got in. Retests, it's extreme. Hits the open of the order block, barely misses it actually. Barely misses the open of the order block and actually starts falling. For you to have been safe, you could have entered right there and perfect. So now let's say you would have fibbed this out. Actually, you would have been well within your rights to hit a 79 entry. Stop loss at the 1 or at the 1.1, whichever one, doesn't really matter at this point. At this point, it's how small do you want your stop loss? 4.1 pips, right? And then your take profit would have been technically open, or as long as you really wanted it to go, you can let it go to the 2 if you want to. Now it's 44 pips, but it's going to go a lot longer than that, right? Because that was distribution on lower time frames. But either way, how much is your account going to grow if you're risking 4 pips for 40? That's a 10 risk to reward. What lot size would you place?
Very big one.
A very big one,
Standard.
right? Because you're risking
Standard.
you're risking a 4.1 for a 44, right? For 44 pips. And even then it can continue going lower, right? You just have to monitor price action at that point. Now let's say you're trading HFX. HFX is on lower time frames, right? It's focused around lower time frames. I called it scalping on steroids at one point, right? Because that's essentially what it is. But if you look at bullish structure and then you end up positioning yourself in such a way that once it reaches your your POI or point of interest, then you end up saying, hey, I am not only going to hit this point of interest, I am also going to make sure that I get my entry on HFX, and I look for my entry on HFX or on lower time frames, right? For you to make double the money. Because I'm pretty sure with HFX, you can make like a lot more money, right? Because like you're buying like 100 shares or type thing.
You can, but it's just like normal forex. You can make or lose however much you're willing to put up and however much leverage you have available at the time.
Okay, makes sense. But like, let's imagine your payout on HFX. Do you have stop losses on HFX? I'm pretty sure you do, right? Something like that.
the people I trade with, it's just binary. It's like it could hit 100.
Oh,
Yeah,
okay.
as long as you're 1 pip in profit, you get whatever you put up. So, it could be just 1 pip away from entry, can go all the way down to the take profit you marked up and then retrace up right before the end of the contract. But as long as it's below my entry point on the sell, it's weird. There's a lot of different parts of HFX, but the one that I trade with is really just for entries.
Okay, let's say for you guys that trade HFX, right? Let's say you know exactly how all those things work, but then you use 1 minute Wyckoff schematics, or you use this order flow. How is that going to help you? Well, let me show you how it's going to help you, because in this position, look what ends up happening. Your take profit just got hit twice actually. Then it doesn't matter if it retraces because your take profit already got hit. You could have held it because it retested this extreme. Could have held it. You would have been another 30, 40 pips in profit. You could have also just held on to it and got your take profit hit again. And if you were a little bit more patient, boom, you would have gone, you went from risking 4 pips to hitting a total of 82. And at this point, New York starts. So when New York starts, let me teach you guys this rule of thumb. Usually when New York starts, London's actions get reverted. So if it was selling, usually it buys. If it was buying, usually it sells. Don't take that as a, hey, as soon as New York hits, I'm going to buy or sell something. Take it as a, hey, I know that London New York reversal is a real thing. Let me see whether or not it would be a safe entry to keep buying or keep selling. Okay, it really all depends on structure as soon as New York opened.
Is that yellow thing an indicator?
Yeah, this yellow thing is the Patty trading sessions.
Patty, okay, got it.
Yeah.
I'll use that.
And I have Asia range on. Asia high, Asia low. Okay. Now, why do you think I would have closed out on my trade at this point right here specifically?
You got another order block?
Yeah. Why do you think I would have closed right there?
Oh yeah, because it hit an order block, breaker block.
Breaker block, okay. But it also, not only did it hit that position, it also moved in such a way that it actually never broke bearish order flow. Sorry, it did break bearish order flow. It broke bearish order flow. Why did it break bearish order flow? Because if we looked at like, if say we looked at, like the 30-second or like the 15-second, what would you have seen here? You would have seen accumulation. This would have been your sign of strength. You're jumping the creek, right? Jumping the creek for those that have done their homework. And then it would have returned and continued on upward, right? I don't exactly know what happened in this position, but as soon as New York opened, I closed because this failed to make a low. And it continued on forward. And it spiked all the way up. Now, here's a perfect example of liquidity getting cleared. You see this? Liquidity gets cleared, left-right rule. On the left, there's liquidity. The right captures it. Since it is moving in our direction, what happens to said liquidity?
It's cleared, pretty much.
Not only is it cleared, it's also
going to go back.
It's also going to go further, right? Liquidity becomes overtaken, right? That makes sense?
Yeah.
Yeah.
Awesome. Does this make sense to you guys? Or are you guys lost?
Just to clarify, buying, when it buys and liquidity is taking itself, it's gonna fail. the previous liquidity that needs to fill, and when it sells, it's gonna like go even further? Or is that just same for buying and selling?
It's the same for buying and selling. As soon as the position has exposed liquidity, if it is going in the general direction that you want the trend to go to. So for example, let's say like in this position, we know that New York is going to be bullish for GU. So
Yeah.
since we know it's going to be bullish for GU, this giant exposure of liquidity, we know, hey, this is going to get filled. But since it's going in your direction, not only is it going to get filled, it's also going to get overtaken.
Right. That rule you said about that push up when it touches the liquidity, it automatically did that. As soon as it like pushed up, it fell right back down for a deep retrace, and then
Fell back down
when,
for a 50%.
not the previous one, before
This
that
one?
Yeah, this one.
This one?
Nah, deeper. The deepest one, where it went up, went right back down. Like when I had that big push up, almost looked like a liquidity void, pretty much.
Which one?
Keep going right. Keep going right. Keep going right here.
Yeah, this one. It shoots
Yeah.
up, then it fills its inefficiency, comes
Yeah,
back
yeah,
down to the
yeah.
order block or the breaker. Consider
Uh-huh.
it both, right? The order block or the breaker. And from there it shoots up, right? So your entry would have been right around here, and then your stop loss would have been right there, right? You could have entered that position if you really wanted to scalp the 1 minute. What would have been your stop loss? Your stop loss would have been a total of 8 pips. If you wanted to move around the middle, stop loss beneath the breaker, a total of 6 pips. Then your take profit at equal highs at 52 pips, and you would have risked 6 pips to take 52.
Yeah.
Which a lot of people get wowed by, like the 250 pips, like 250 pip take profits, 300 pip take profits, swing trading. Everybody's, everybody's like, super like amazed by these quote unquote swing traders, when really you don't need to swing trade. You can catch 3, 4, 5 of these moves a day, and not only will you get it hit a
Quicker.
day, you will also be placing larger lot sizes because it's six pips. And since it's 6 pips, what is going to end up happening? You're going to put the smaller the stop, the heavier the weight. And from there, you end up making a lot more money because your TP got absolutely smashed, right?
So I got a question.
Yeah.
Right at the beginning of your long position, that purple candle that's rising, wouldn't that still be considered still a full value gap? Fair value gap, sorry.
Where at? Right here?
Yep.
Yeah, so it is a fair value gap, and then it gets mitigated 50%.
So if it so not even the bottom doesn't, there's no wicks, you don't have to worry about clearing or taking any price out of it, right?
I can't hear you very well. You're kind of.
Hold on, I got headphones in, I'm at work. Can you hear me now?
Yeah.
Yeah, so at your stop loss, and even at the bottom of that up thrust, would that be like a target for liquidity?
This one right here.
Yeah, and all the way at the bottom.
Right here?
Keep going. Well, no, right there actually, because yeah.
So it could be, but not for right now. Not
Okay.
until you actually see bearish order flow, because there's no reason to sell here. It could be a target. Keep that in mind, but it isn't. It isn't quite relevant yet because you're not selling.
So you just, whenever you're looking to clear liquidity, you just stick to the trend.
If you what? Sorry?
You're looking to clear liquidity, you just stick to the trend basically.
You stick to the direction you stick to the direction that your order flow is pointing you toward. Meaning, in this direction, you saw bullish order flow, perfect. you shoot perfect. You shoot bullish order flow. If you see bearish order flow, you shoot a bearish order flow.
Okay.
Okay. So until you actually see bearish order flow, I would not suggest you actually target that liquidity. However, if you end up, you know, if you actually end up seeing bearish order flow in the future, you can very, very easily take that position and say, okay, no problem. I will take liquidity off of that position, and I'll aim for that, for those liquidity targets, because yeah, they could be liquidity targets.
Okay.
Has this helped you guys? Like, has this made sense to you guys?
Yeah.
My mind has been blown because I've never traded before.
Well, welcome on board, kid. By the way, do you have your broker set up?
I'm in the process of setting it up right now.
Okay, with what broker?
Eagle FX.
All right, perfect. So you can have that set up. Apart from that, okay, let's look at EG real quick, because I know Hav wanted to look at. I literally typed in EG. I feel like an idiot. By the way, Hav, has this helped you? I want to make sure that you're also getting helped.
Yeah, for sure. Especially like the liquidity part. Yeah. Once I got hold of that, I started becoming way more profitable. Now, when you pull it, if you pull up EG on a woman, then you can see how like it got two crazy wicks.
EG on the 1 minute.
Yeah, it's like
Right here.
Yeah.
Yeah, perfect. So in this position, you see bearish order flow, right? Now this liquidity gets killed right up here, right up there. And what ends up happening? This extreme gets targeted, previous extreme gets targeted. Now what happens? This position continues clearing it. And now when it clears it, now it's starting to drop back down. So this is where either bullish or bearish order flow gets confirmed or denied.
All right, but so the rest of that candle isn't going to get filled.
What?
As far as the market going down, like the rest of that candle isn't going to get filled. You don't think? Or we just got to see.
The rest of what candle? That it was filled. This was filled. Look, it was filled. It was covered by a body.
I was talking about the other way, like, so it doesn't have to be filled like negative. I said negative. Going down
For the sell.
yeah, for the sale. Cause it's on like if you look on the woman and you zoom out, it look like it's on like a little downturn.
Yeah, but now let's look. So we shouldn't be making our inferences based off of the 1 minute. We should be basing our inferences off higher time frames and getting our entry off of lower time frames, right? So let's look at the 2 hour and then let's see what's up. So we have these giant fair value gaps. We have enormous fair value gap. Like at the moment, I don't really even think that like these need to be filled soon, right? At least to down here. So the one thing that I'm probably going to be looking for is I'm going to be looking for retraces, and I'm going to see how price reacts at this point. I'm going to see how price reacts at this point and at this point. If it never actually reaches these points, then those are going to be further liquidity targets in the future. Then let's say we look at the weekly. Does this look like something?
What?
Imbalance.
Imbalance. Right here, right? This imbalance right there, and for a lot of people that don't know what an imbalance is, it's essentially what like the place where a candle kind of upsets the order of how price is flowing at the moment. So here a lot of people would have said, oh, this is up, this is distribution. But this just absolutely got annihilated, right? The trading range got annihilated. So the upthrust is no longer mitigated. It's something that needs to be captured now. So this is fake distribution, right? So what's going to end up happening?
Is it
Going to fill that
reequilibrium?
balance.
Most likely this liquidity up here is going to get taken out. Now, are we going to wait? No, we have to wait for that order, for that position to actually reach us, right? Meaning that we have to make sure that we're not just looking at a higher time frame, making something up and hoping it hits. We have to make sure that our lower time frames actually hit those other time frames, right? Actually match up with lower time frames and lower time frame order flow. And then we take our entry, right? Because price is what? Starts with an F.
Fractal.
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 Since price is fractal, you will know if your assumption or analysis is correct if the lower time frame support it. Does that make sense?
Yeah.
Mm-hmm.
Yep.
Has this helped anybody? Does anybody have questions that you may want to go over?
I think.
No, let's just,
Oh,
can we analyze a pair?
Can we analyze a pair?
Yeah.
Yeah.
Just like a random pair.
Throw me a pair.
I don't know. Let's see.
USD CAD, I guess.
Yeah, it really doesn't matter.
USD CAD, perfect. Let's look at USD CAD. You see what I mean by targeting extremes? Literally, like you can't make this up. It targeted this extreme and it fell. Right at the top. Right at the top.
So what's the difference between, like how you say, or whoever people say, like retail traders look for double tops and double bottoms? Like, what's the difference between that and this?
There's no way this is a double top. I think I see what you mean. Because double bottoms and double tops don't exist. They're not real. They're pauses in price, but they're not. They don't exactly matter.
Okay.
Because usually below or beside or above, there's going to be another form of price action, from what I just taught you guys, that will include that will include accumulation. It may include distribution, whatever the case may be. And that's a lot of times what causes those, but not what should be. You shouldn't trade double tops or double bottoms.
Okay.
So right here we see a completed a completed accumulation schematic, because we have our position right here. We get our spring, we get our test holds, our last point of supply holds, gets retested on the order block. You enter on the order block, stop loss behind here, right? And then your target is equal high. What happens? Boom, your equal high gets purged. So now right here, we don't exactly have much to go off of on the weekly because our accumulation schematic was already completed. So we want to look at relevant current price action. So let's go to the 4 hour. And what do we see here?
Distribution.
I don't really see much of anything. Like I don't see much. I don't see a schematic at all.
That's the distribution because I see it falling down. I see it dumping.
Well, up here it could have been distribution in lower time frames, or up here it could have been distribution in lower time frames. but not right here. Here's another example of an order block, which is also, like you said, Hav, this is an example of a drop-based drop, right? The drop, the base, and the drop. But you have to learn when to use the drop-based drop. You want to use the drop-based drops when it is in between another structure, meaning that, for example, distribution, redistribution, reaccumulation, and accumulation. If you see a drop-based drop or a rally-based rally or a rally-based drop, whatever the case may be, you will usually end up seeing that retrace happen there, so that you can now see where within that structure price is going to be hit, right? So as we have right now, personally, what did we end up clearing up here? We ended up clearing this previous zone, cleared liquidity up here. There's two positions. Oh, it missed this. Okay. There's two different places that I would like to see price go. I would like to see how it reacts around this zone. Okay. I would like to see how price reacts around this zone. If price does not reject off nicely, I would like to see a return to up here for a sell, personally. However, if it reacts off of this zone right here and then buys up and actually takes this out, then I would consider this a respect of this test, right? And then that would be considered our that could probably be considered a change of order flow. Okay, so I want to see how price reacts around this point, and then from there I will let you know my bias. Like you want to adjust your bias. So there are certain times that you should be trading or should be looking at charts, right? And there should be other times where you are not looking at charts, because staring at a chart is going to kill your psychology. Okay, and how you do that, essentially, I'm going to give you a list of times that you need to be doing that. Okay. No problem, Zaman. Take care. This is going to be the last thing as well, because I know you guys are busy and I've taken up like an hour and something of your time. So essentially there's going to be two, right? There's going to be Asia kill zone, which ends up being from broker hour, wherever you may be, to 2 hours before London, wherever you may be. You can translate that to your terms. Then it should be New York session, 7 o'clock Eastern, 7 a.m. to 11 a.m. Eastern time. Then it should be New York session, and then from there you have a little sometime that is optional, but you guys can use it. It is the London kill zone, which ends up being from 2 a.m. EST to 3:30 EST. So write those down. These are the times that you can that essentially you can focus on price, and it will be most beneficial to you, because those are the times that usually price ends up moving, has higher volatility, or will set up. For me, I mark up during Asia kill zone. I end up trading, live trading, 7 a.m. to 11 a.m. And I end up looking at my London kill zone. I wake up for London kill zone just to look and see what's up, and then from there I go back to sleep, so that I can keep in mind, remember London to New York reversal, so I can keep in mind what the direction of the market is and if there are any points of interest that I would like to see hit during New York session. Does this make sense?
Yeah.
Yeah.
I just gotta put it in action more.
Yeah, same here.
Well, let's go ahead and be disciplined traders, okay? Because if you're not a disciplined trader, you're not going to find success, okay? The point is being well-informed and well-disciplined. That is why I moved into this community, and that is why I'm teaching my team in this community, because I'm going to be focusing on your guys' development as much as I possibly can. So if you guys have questions, please hit my DM. And yeah, I'm glad that you guys actually tapped in, the guys that came in from TJ and from the other people that I just gave out the link to. Thank you guys for being here. And if you guys want to keep going with me, then just send me a link. Send me a DM, and we can talk. Okay.
All right.
But
All right. Thank you guys so much for coming, and I'll talk to you guys later.